lot of events globally and in India which could potentially move markets substantially. But for that, to take stock of these events and what implications they may have on equity markets in general, we're in a conversation with Jonathan Schiessl, the CIO at Ashburton. Jonathan, thank you for joining us. Well, my first question will have to do with the FOMC meet, the upcoming FOMC meet. What would you be looking for when it comes to commentary? And how many rate hikes do you think the Federal Reserve can take, say, over the span of the next 1 year?
So I think obviously the market clearly is pricing in a rate rise. That's clearly more than baked in for this month. But obviously next year and beyond is where the debate goes, because clearly if you look at the dot plot as such, the market doesn't believe where obviously the dots are going, and obviously the Fed is somewhat higher in interest rates than the market's currently pricing. And I guess everybody at the moment is clearly very much focused on the yield curve and that wonderful predictive power of the inverted yield curve, which has for the last, I think, 7 occasions predicted an upcoming recession. From our perspective, we wouldn't be too concerned about growth next year from an economic perspective, from a macro perspective. But it's probably for 2019 is probably where things start to get a little bit more interesting. So I think next year is going to be one of massive debate about where the FOMC is. Do they get 4 rate rises? Do they get 3? And I think that's going to be something which is going to be ongoing throughout the year. And obviously we want to see what happens to inflation, see what happens to that jobs data. But at the moment, from a macro perspective, we're quite comfortable. But clearly, when you push that view into asset prices, then that's another debate altogether.
Jonathan, we also saw some corporate tax cuts come through in the US. What implications can they have for American equities? And what would that then mean for global markets in general, and perhaps then its implications on emerging markets then?
Yeah, absolutely. So I think clearly, Trump seems to be getting his own way on a few key policy promises, tax cuts, and a few of the other more recent, more controversial policies seem to be getting through as well. Obviously, the tax cuts, if it improves the competitive of corporate America, the competitiveness, then it is certainly a positive from a market and in a corporate America perspective. And then clearly, I guess the thing for emerging markets and globally is what effect or impact will that have on the dollar? Because obviously, if corporate America is going to get this huge boost from tax cuts, then clearly the Fed will probably be even more concerned about the inflationary impact of, for example, corporate America beginning to finally spend and actually increase capacity. So I think globally it is certainly a positive, and if America's clearly doing better, then that's going to pull the rest of the globe up. But if that means the dollar suddenly enters into an era of strength again, then that'll obviously have implications for emerging markets and all markets globally. So, yeah, look, it's a positive move. Obviously, we've got to wait till it's finally pushed through. But and now it's interesting to see there's pressure on some other parts of the world to reciprocate and actually cut corporate taxes. I've been hearing that's happening in India. It's certainly trying to take place in the UK as well.
So, Jonathan, in the backdrop of what's been happening in the US and, of course, the kind of divergence in the actions of global central banks, you have the US and even India's RBI on one hand, which are moving towards tightening, and then you have the ECB and Bank of Japan on the other hand. So in the light of all these central bank actions, where there are significant divergences, how do you think the emerging markets are placed relative to the developed markets? I mean, on what would you place your bets?
Yeah, so I think it's interesting. I guess if you look at the street, most people are quite positive on the EM outlook, certainly for next year, even though obviously emerging markets generally, in India as well, have had a good 2017, so far. I think obviously the world and his wife are worried about US valuations. And that's one of the reasons why I think broader EM is still, even after the run we've had, quite an attractive proposition for quite a few developed market investors. I guess the issue for India in that perspective is the broader EM space certainly looks quite cheap, even after the rally we've had, and you couldn't sort of say India looks cheap. So I think India will benefit from, I think investors will probably still allocate to EM, even after the run we've had. But obviously, yeah, it comes back to what's going to happen with the dollar, which emerging markets in particular are set up for a stronger dollar or not. Those emerging markets that do have high, US dollar debt, et cetera, all the usual reasons which causes an emerging market crisis when we see the dollar strengthen too much. But yeah, look, I think next year's that's going to be the crucial debate, and that's going to be one that will just roll throughout most of the year.
What about India? Do the Indian markets look really tired to you right now? Do you expect some consolidation? Where do you think they're headed in terms of levels, at least the direction?
Yeah, so I mean, we're still incredibly positive on India on a 3, 5, 10-year view. But yeah, you're absolutely right. In the short term, obviously, what's happened is we've seen, the continuation of the recent re-rating rally. Obviously, corporate earnings need to kick in, and with all the disruptions we've had over the last year, it's still debatable if earnings are going to start kicking in a meaningful way. The street is probably consensus on Indian earnings for next year are probably still too high, and they still do need to come back down. But even that aside, we would expect Indian earnings to still post decent double-digit growth next year. So some of that earnings recovery will come through, and I think a lot of the uncertainty from demonetization, from GST, will start to unwind. And I think one of the points that's been made previously is that because of demonetization, because of the disruption from GST, the base is incredibly low. So it doesn't take much for optically for India to look as though it's really starting to push ahead, even though it might be base effects kicking in more than actual real underlying growth. So actually, I know the RBI we had out yesterday, and the commentary was a bit cautious about inflation. We're not 100% of the view that the loosening cycle in India is finished. We still think inflation looks fairly well contained in India. And there is a possibility that in the first few months of next year that actually rate cuts could come through. But clearly we need to see what happens with energy prices. We need to see what happens with the dollar before we can take that. But yeah, all in all, I think probably the market needs to consolidate. There is a lot of hope and anticipation built in about continued strong domestic flows. I think maybe that'll slow down a little bit, but foreign investors haven't really participated a great deal. So, we're not too disheartened about the prospects for next year. Perhaps not such a big year as this year, but actually I think next year might surprise.
Just theoretically, if we do see a minor correction coming in the Indian markets, would you look to add to your Indian portfolio, or you wouldn't be in a rush to buy?
No, absolutely. We'd certainly add. So, I think, as I said, we're obviously heading into the national election in 2019. We've got the crucial state elections coming up, so that could, generate in the short term a bit of volatility. But ultimately, we do believe we're at the bottom of the cycle. Yes, the earnings are taking time to come through, but a lot of the structural reforms that have happened, that have been put in place, are disruptive, and we do believe that will be worked through. So we still can find a lot of very good Indian companies that we would like to invest in. And then, of course, if we can actually put money to work when they're 5, 10, 20% cheaper, then that's all the better.
How comfortable would you be if we were to see a fiscal slippage of about 20-30 basis points, because concerns on the fiscal front have only been increasing in the recent past, mainly on account of the slower GST collections and, like you mentioned, the rising oil and commodity prices, which really impacts India directly?
Yeah, so I think clearly it's something that we have to watch out for. But I think we're not too concerned about it. It's creating a lot of noise. But I think ultimately this whole transition for GST, it was always going to be a tough one. You don't introduce, reform your tax system like India's just been doing without having a few headaches. And clearly with that process will take a few more months. Absolutely. There's no doubt about that. But we would think ultimately once we're through the other side, that actually, I'm not going to worry about a few basis points of slippage. I think India does have that very high growth opportunity. I think we're at the bottom of the cycle. And I think the steps that have been put in place will mean the cycle will last longer than what we've been previously used to. And certainly from a fiscal perspective, we're not too concerned at the moment. I think, but it does bear watching.
Right, Jonathan, you said that we're coming on the back of the implementation of GST, which has, caused some challenges, and we could perhaps expect some novelty, perhaps in the third or the fourth quarter. That said, of course, we will also have the base playing out, the base effect on demonetization playing out for the third quarter. My question then is, keeping both these aspects into consideration, how did you read the first half of this financial year when it comes to earnings? And what can we expect as we move into the second half when it comes to Indian equity earnings?
Yeah, of course, because there's a few. I guess the fact is we all are fixated with indices, Sensex, Nifty, and of course, when you look at aggregate earnings, it's hiding a great deal of divergence in the underlying sectors. And clearly, the recent pickup that we've seen in earnings has been predominantly driven by, if you like, global type of sectors, so energy sector, commodity sectors, and those sort of areas. And that's where we've seen most of the growth so far. And obviously there were impacts to some of the domestic facing sectors from the points you've just raised. So I think we will see a shift again as the underlying economy calms down and people get to understand how to use GST in an efficient manner. And we get the base effect sort of kicking in. I think actually growth will surprise on the upside, and therefore, as we all know, there is a link between underlying economic growth and earnings, and that will come up. So the street is probably still too bullish about overall prospects for next year. So we probably still haven't finished the downgrade cycle. But all in all, we could see anything between 15 to 18% earnings growth still, which isn't too bad.
Right. Shraddha has some interesting data points because RBI has just held a survey in terms of consumption. So, before I go to Jonathan, Shraddha, why don't you just tell us about what that survey has thrown up in terms of trends in consumption?
So, well, Agam, sadly, the RBI consumer survey only shows that the Indian consumer is not really upbeat right now. I also believe we have a chart which is ready, which we can pull up. So, if you look at the red line, which is the current situation index, you will actually see that we have seen a declining trend, and not just that, in fact, it has remained in the negative territory for the fourth consecutive survey. Even in the latest survey, of course, which came out yesterday, there's a big drop in the number to 91.1 from 95.5 that we had seen in September. That's just not the current numbers, but even if you look at the future expectations index, which is the blue line, which actually tells you about the one-year forward outlook, while that does remain in the optimistic zone, the trend again there as well has been on the decline. So broadly, what is the reason? Well, the RBI survey points out that the drop is on account of the fall as far as the optimism is concerned with respect to the general economic situation and, more importantly, the employment situation. So there's this table which shows the breakup of the survey, and if you look at the employment variable, you will see that it has been on a declining trend and it is now at minus 19.2. Even if you look at it from a one-year forward perspective, the down green arrow, which actually means that while it remains positive, the extent of optimism has reduced from the previous survey. So all of this, of course, has major implications for the economy. And I also want to bring in a point that during the Q2 GVA data that we got, it did show some decline as far as the consumption expenditure is concerned. So broadly, these has two major implications for the economy. First, of course, it was the consumption demand that was actually holding up the economic growth so far. And secondly, you do need this consumption growth to hold up if you have to have the investment cycle pick up, which is unfortunately, this data or the survey doesn't really show up a good data points or outcome. So Jonathan, coming back to you, just wanted to understand that so far, of course, everybody was worried about the kind of time or the delay that we were seeing in the investment cycle taking to pick up. But should one also start worrying about a slowdown in consumption expenditure, because ultimately that will have an impact with respect to the consumption plays as well?
Absolutely, and clearly rising energy prices isn't going to help particularly as well from a consumption perspective. I guess the question is, with these surveys, are they capturing, pan-India? Clearly, there's been some stress in rural India, and that certainly probably will have held back consumption, whereas I imagine urban consumption data looks still very positive, or better, shall we say, on a relative basis. Yeah, I mean, we all know consumption has been holding up this economy for the last couple of years, and we've all been waiting with bated breath for many quarters for this much heralded revival in the investment spend. And clearly, there are still headwinds in that sector. I think obviously the recapitalization of the PSU banks is certainly one big tick in the box. And then obviously, we've just got to let growth do its work, because there still is excess capacity in certain sectors of the economy which need to be worked through before you'll see the private sector really begin to kick in. But I think, all we need is a bit of positive data. We have had two incredibly large disruptions that have hit the economy in the last year. And, it's bound to be a little bit difficult this period. But I think clearly, from a government perspective and a more pro-growth perspective, announcements will be coming out of the government as we near the national elections in 2019. So, whilst I'm not expecting the economy to roar away anytime soon, we do believe that with all the plans in place, with the focus on growth again, that we should see a gradual revival in that investment spend. But probably still very clearly, the government probably still doing the heavy lifting for the time being. And, time and corporate balance sheets need to be repaired. And the private sector will probably kick in a bit later.
Okay, Jonathan, thank you for being patient with us. But once again, I want to go to Agam, who has collated some data on IT majors before we can come back to you with a question.
Right. Well, I actually wanted to talk about information technology because Ashburton does have substantial holdings in Indian IT stocks. So let's pull up that table. And what I did was I just wanted to take out the returns on a year-to-date basis for the top 5 Indian IT companies. So that would include something like a TCS, Infosys, HCL Technologies, Wipro, and Tech Mahindra. And in terms of returns on a year-to-date basis, you'll notice that Wipro has done the best. It's moved up by as much as 18.5%. That's followed by TCS. Infosys, HCL Tech, and Tech Mahindra haven't given substantial returns, at least this year so far. Even on a valuation basis, and this is Bloomberg Consensus FY18 price to earnings ratios, you'll notice that HCL Technologies and Tech Mahindra are relatively cheaper at around 13.8 times, as against something which is more expensive, something like a Tata Consultancy Services at around 19.4 times. Infy stands at around 15.5 times, and Wipro again similarly at around 15.3. But Jonathan, before I take that question for the entire sector to you, there was a development in Infosys, and I know that Ashburton, at least one of Ashburton's funds, holds a substantial stake in the company. We've had a new CEO and MD come in. What would you like to see the CEO and MD do in terms of strategy when it comes to Infosys specifically, when you consider the way it positions itself in the markets abroad?
So, I mean, clearly, For us, I think the appointment was, we were very heartened to see the appointment, and the experience of the new the person joining the company. It looks to be very good as well. So yeah, it's been a tough year to be an investor in Infosys. And it's, the excitement's certainly happened elsewhere in the market, and IT has been difficult. And then in particular, Infosys has obviously had all its own internal issues, which have clouded the story even more. Clearly, it's a company in transformation. As an investor, what we like is stability. So we've got a new man on board, and what we want is a very clear, articulated strategy about where the company's going and where it's going to, the areas that it'll carry on focusing on. I think they were on the right track under the previous regime. So I wouldn't want to see anything too radical. I think that's fairly obvious that the company will be focusing on a lot of the core areas that it was already transitioning to going forward. So, yeah, I mean, for us, what we want is stability. We don't like companies which, turn inwards and fight, and you have corporate issues and promoter issues. So we need some stability out of the stock, clear focus and a clearly rationalized focus about where and what the company is trying to do. Because clearly, as you just point out a moment ago, Infosys is trading at a fairly significant discount to TCS, and I think if we can get that clarity of vision and continuity in the company over the next few quarters, then there's every reason that we would expect that valuation disparity to close. Not necessarily even out, but certainly it's quite a large valuation disparity by historical standards.
Right, and I understand along with Infosys, one of Ashburton's funds also holds a substantial stake in ACL Technologies. My question to you then is to do with the sector in general. A lot of these larger companies still have a lot of their revenues come from traditional businesses. And that said, we are looking at a considerable change in client requirements. And a lot of these companies are still, should I say, to a certain extent, struggling to adapt to the big changes. So my question then is that how do you see the evolution of some of these larger IT companies going forward?
Yeah, I think you've hit it right on the head there, the nail on the head, because clearly a lot of these businesses are transitioning and some are finding it harder than others. For us, why we continue to hold positions in IT names, it isn't purely just about the individual stocks themselves. It's also about to a degree about portfolio risk. And clearly when we look at the rest of the market and valuation, IT is cheap, and it's cheap for the reasons you highlight. There are transition issues and growth issues, et cetera, et cetera. So, but in combination, when we're looking at an entire portfolio, and for us, IT does give a slight balancing factor. Market where it is, valuations of certain sectors where they are, IT provides a bit of, it's under-owned, as we all know. And it provides, we've got the valuation support, the dividend support, in particularly Infosys as well, and the buyback going on. So, it's from an overall portfolio position and a risk perspective. We're also, it's probably why we've held on to these stocks. Certainly, when you look at the returns compared to the broader market, it doesn't seem like a very good position to have held, and it has been painful. But we try, when we build a portfolio, to think about risk as well and investor positioning. And I think if we were 110% invested in consumer-facing, expensive staples and all these sort of stocks, then there's a lot of risk embedded in those portfolios. So, yeah, we try and look at it both at a company level, but also from an overall portfolio level. And that's probably been the reason why we've stuck through these companies through the tough times over the last year or couple of years.
Jonathan, I believe you have increased your exposure to some of the Indian financial stocks, HDFC, ICICI Bank and Capital First over the last 6 months or so as far as your India focused fund is concerned. But of course, in the last few months, we have seen some moderation that has crept into the home loan demand and overall the credit demand per se as well. I mean, of course, the credit demand has picked up from the levels that we had seen post demonetization last year, but it still remains in single digits. Just wanted to understand what your stance now is with respect to Indian financials.
Yeah, so we've actually, in the last few weeks, done something I haven't done for a very long time. We bought a PSU bank. So we bought, excuse me, State Bank of India. I'm actually quite optimistic about the outlook for corporate banks in India, be they something like an SBI or an ICICI or an Axis Bank. I think when you look at the valuation discount between the corporate banks and the much more highly valued retail-focused banks, I think that there is quite an attractive story here. And when you look at a number of factors, obviously that bank recapitalization to us was an important event. Yes, it's not much, risk capital going into these banks, but obviously, I think the PSUs can come back in the market. I think the rising yields we're seeing in the India 10-year market are clearly making banks, from a corporate perspective, more competitive vis-a-vis the bond market in India, which has obviously taken quite a bit of market share over the last year or a couple of years. So I think, the space for corporate banks, with the idea that the economy is recovering, bottoming out, and beginning to start growing again, and the fact that most of the banks, a lot of the issues, though not all, have been addressed for the weaker banks. I think it's a great time to actually be owning corporate banks, because I think we are on the cusp of a revival in credit demand, be it for working capital loans or for whatever it is. But as you rightly say a moment ago, that we've had a few months of an uptick in credit demand for the banking sector, and we think that will continue and grow. And clearly, as I said earlier, the rising yields in India make banks more competitive versus the bond market. So we're actually have been incrementally putting more money to work in the corporate banks. And the financial sector looks very well positioned to us.
All right, and just the last question before we can let you go. I just wanted to share with you our experience. Every morning that we step into our office, we just realize that Bitcoins have gone up by another $1,000 overnight. So just wanted to understand if you see merit in investing in cryptocurrencies, or do you believe all of this is just a frenzy? I know it's a tough one, but if you have any thoughts on this.
Yeah, look, I'm a bit of a fossil, I'm afraid. I struggle to get my head around some of these Bitcoin and these cryptocurrencies. I think I prefer, if I had to go anywhere and diversify, the yellow metal to me, I still find quite attractive. What worries me fundamentally about cryptocurrencies and Bitcoin is, obviously, as they're beginning to get more systemically important, then clearly regulation is going to kick in. What's going on with black money and all these sort of factors. Governments eventually will, I think, start to try and regulate the cryptocurrencies more. Ultimately, I just can't see central banks globally letting go of paper currencies. So, as I said, maybe I'm a bit of an old fossil on that front, and I need to be educated about these things a bit more. But so yeah, it's something I've been looking at. A few of the guys in my office, on a personal basis, do play this sort of area, but not me. But yeah, it's certainly fascinating.
All right, thank you very much for joining us here at Bloomberg Quint. Really appreciate your time, Jonathan. And with that, it brings us to a wrap on this edition of Thank God It's Friday. Thank you for watching.